Okay, everyone, good morning. Happy Thursday to you wherever you are. Australia, New Zealand. Morning here in Eastern Europe. Overnight in the States. Hope you all are well. Thank you for tuning in. Got some good charts again today. I want to continue on this idea of measuring the United States debt in different ways to understand it. So let's go through some charts here. Actually, sorry, I gotta get myself on there for fun. All right. My live streaming setup still isn't as smooth as I would like it to be, but let me know if you can't hear me. Okay. Sorry, actually, one more thing. Did I start this? No, I didn't. Like I said, my live streaming setup is still working through it. All right. So I like this chart a lot. And stop me, by the way, if you have any questions. I've talked about this past couple weeks, but I keep adding a little bit more things here and there. U.S. federal debt over the entire history of the United States. Okay. 1776 was the Declaration, but after the Articles of Confederation, getting the Revolutionary War won and everything, wasn't until really the 1790s that things got settled down in the United States. They did have a national bank, which Jefferson didn't want and Hamilton did want. But here's the debt. Okay, here's the debt. And as I've said, the United States had Revolutionary War debt from the French, Dutch, and the Spanish. Most notably, the French helped them with many, many things. Blockading the Brits, fighting against the Brits, more ships, soldiers, artillery than American at certain battles. So there's nothing more American than getting your help from your friends, okay? But and I really don't say that flippantly, okay? Living in here in Eastern Europe, it's what the world is going through again. Everybody is going to have their 1776 moment at some point. Can't deny that Ukraine is having it right now. They're not even asking for soldiers; they just asking for support and weapons. All right, so let's try to evaluate where we are with the United States. Let's take off these percentages. Again, we've talked about this a lot. This is just as of March, okay, 2025. Federal Reserve holds $6.4 trillion worth of U.S. federal debt. The total debt is $36.2 trillion. All right. You put this in a percentage, okay, and it looks like this. I'll take off the gross dollar of the Fed just so we can, because I'm going to start putting other percentages on now. All right. We've talked about this. We've shown this. The Fed's got room, at least with historical precedent during COVID, to go back to 30%, 27% of the debt. Okay. Monetizing. That means that for every dollar that's issued and outstanding to the public, that the public can own of U.S. federal debt, the Fed has 28 cents of it. All right, that was what it meant in February 2022. This was a historical high. Never had the Fed had that much debt. Okay, it had 15%, 18% at the end of the Vietnam War. And the percentage here actually only went down because the U.S. started issuing more debt to foreigners than the Fed itself was taking. Okay, so it's down now. All right, so at least from the perspective of monetizing debt, it's down. It's only 18 cents on the dollar that the Fed has printed. You can measure this stuff. The data's out there. You just gotta work through it. All right, so this is the Fed's monetization of the debt. Now we have foreigner holding of the debt. All right, I've shown this already as well in the past couple weeks. All right, so a peak foreigner holdings of the US debt actually occurred after the global financial crisis. This was peak dollar safe haven status. This was, are you scared of the economy? That certainly the Federal Reserve had a hand in damaging. No argument for me there. But are you scared of it? Do you want a safe haven asset? Well, go into dollars, buy treasuries. This is peak fear. 2011, 35% of the U.S. federal debt was owned by foreigners. Foreign companies, foreign central banks, foreign pension funds, foreigners. That's down as well. That's now down to 23%. Now, I keep talking about it, just adding these up, and it's time that I actually just show you what's the American share now. When I say American, it means non-foreigner, non-Fed. Because the Fed, can talk about that all day, but it's not quite a government entity. It's not quite a private entity. Okay, it's not a fully private entity. It certainly has government oversight and all the rest, but you know, people like to argue about that. That's not the point of this video. Non-foreigner, non-Fed ownership of the debt. Let's put it on now. All right. Now, as we know, we're looking through peak numbers here. This is probably going to be a peak low. We'll back it out. But a peak low here in 2014 is after the QE 123. A peak low is quite an oxymoron, huh? This is a nadir in the number for American ownership of its own debt, 42%. This is why you got to be careful if you're one of these Keynesians and likes to say that we owe it to ourselves. Not here. In 2014, we owed 60% of it, 58% to foreigners and the Fed. It's not to ourselves. All right, but let's back up. Generally, I'd say, you know, though it's fine to have foreigners own debt, it's fine to have interest in treasuries. You want to be careful if this number is too low and too in the control of foreigners. But now it's back up to 60%. Okay, American. When I say American, I mean private individuals, those good old savings bonds, which no one buys anymore for their kids, pension funds, hedge funds, retirement savings accounts that hold fixed income securities, that is United States fixed income securities, 60%. All right, so let's back it out and see the trend. Okay, as long as I have all three metrics, I start this one. So as you might expect, back when the Fed was founded, and even during the Great Depression and World War II, most of private debt was held by Americans. And this is important to talk about. I'm zoomed in too close here. Because as I've said many times, there's this theory out here that's getting a lot of traction that, again, the United States is responsible for every problem in the world. And as we know, that's what the Dave Smith, Douglas Murray debate was about. I'm much more on the Douglas Murray side there, though I certainly can have my quibbles around the edges. There are also facts and historical data points that we can look to. America didn't make Germans Nazis. All right, no matter what Dale Cooper might want to say, America did not make Germans Nazis. Yes, they had tough reparations. I've shown this many times. But after World War I, the Federal Reserve still had very little holding of the United States debt. Okay. JP Morgan's share would be much higher, that's for sure. But the Federal Reserve's share is quite low here. And then even as World War II starts, and before the United States even enters the war, you're at 95% American ownership of this debt. That means the U.S. government raising it from private institutions, private individuals. It is true that after the war, this goes down to about 90%. In the grand scheme, that's quite high. is quite high. 90%, 95% ownership of the U.S. government debt. This is theoretically says that the United States was behind the war. Yes, you can quibble with this. We can write 1,000 books about it, but 90% of Americans privately held government debt at the time of World War II. 95. When the war finished, yes, Bretton Woods started. 90. Okay. Now I've shown this, but I'm gonna pivot today. We're gonna show another. This is about backing of the debt and where the debt could be. But clearly, the point is, and this is a problem with the Triffin dilemma, right? So where Jeff Snyder talks about this a lot, and this is the Eurodollar theory, the dollar milkshake theory is, even if the United States runs deficits, even if the United States increases debt, if it's the world's reserve currency, people are going to want to hold that debt, especially during times of crisis. You saw that here. All right, so this was peak dollar safe haven so far, where you had a nadir in Americans holding it. All right, this is February, actually by November. Let's just catch roughly. Yeah, by the end of 2014, which is precisely when they stopped printing money, by the way, the Federal Reserve. They started backing off. Look at the green now, the green percentage. It goes down all the way to September 2019. But right about here, this was peak, and this, we may look back at this as being peak dollar safe haven. It takes a long time to put these trends in place. But at this point, late 2014, early 2015, when all the QEs were done, when all the money printing was done, the papering over of the global financial crisis, it was 60-40. Foreigners and Fed to Americans. That's now come way undone. All the while, huge increases in the debt, as you know. At this point, it's just amazing to look back at these numbers, even from 10 years ago. Literally, just a little over 10 years ago, November 2014, 18 trillion in debt, now double. All right, and that shows you, by the way, the growth rate, rule of 72 right there. If I doubled in 10 years, that's a 7.2% compounding per year, rule of 72. Roughly, just take 72 divided by the rate that it should be without the percent sign. So that is 72 divided by 7, roughly. That'll get you 10. Tells you the doubling time. So the debt from this point, for sure, has been growing at a compound growth rate of 7% per year. It goes back, remember what I told you yesterday about the growth of the gold price versus the growth of GDP, so on and so forth. These are things to think about when we think about investments to hold our wealth. All right, so this is the debt side, and this is also the appetite for that debt. The appetite for that debt is manifested in these lines, okay? So Americans, whether they want to or not, they do hold only 60% of the debt, whereas, again, around World War II is 95 to 90%. Foreigners around World War II had, nothing of U.S. debt. Now, 23% from a high, down from a high of 35%, and the central bank down from a high of 28, 29% in 2021 is 18%. So interesting. In my opinion, this is a very fluid and helpful chart to just show us this is the appetite for U.S. debt. Now, let's look at this proverbial idea of what backs the debt. What backs the debt? All right, so I'm going to go to this chart. Same chart with the debt. Okay, let's even take this off just to. All right, so same chart. Debt obviously explodes during the Civil War, during all wars. Jackson cut off the debt here, although he also cut off the lives of many Native Americans. Nobody's perfect. Nothing is perfect, by the way. I'm not a Jackson sycophant like there are many in the hard right movement. Here we are. This is the debt timeline again. Now let's show how much gold was in the United States government's coffers. That is either the Treasury or the Fed, both put together. Okay, we'll put that here as a percentage. Now this is interesting. Okay, so let's just go back to the war times again, and this one we can even go pre-Fed. Okay, so this is where the Treasury is holding this, and United States had very bad monetary policy always. It was not like Canada, very decentralized, not like Scotland. Both entities, by the way, which were smaller, more nimble. The United States was a big country, but they still had very central banking-like activities, even without a central bank. So you can see it's just very wild swings here. Notice how with World War I, a lot of debt comes into the United States. There is, not debt, sorry, gold. This is gold. The black line is gold as a percentage of the debt. All right, so here when we have World War I, the U.S. has $3 billion in debt, $1.5 billion in dollar figures. This is gold was $20 an ounce, was in gold. Okay, this goes down after, of course, the United States is increasing its debt as it enters the war, so the percentage goes down, and then it repeats again during the Great Depression. In both cases, World War I and World War II, you might ask the question, why did this go up? Well, it's a product of a couple things, but the main thing is Europeans are selling their gold to the United States for arms, for weapons. Okay, they're buying weapons for gold. Britain is the primary culprit here of why this is rising so much. And as a percentage, it's interesting that both about 50%. I haven't, fully vetted these numbers. These numbers historically come from Nick Laird. Of course, he's getting them from, Treasury bulletins. He's getting them from different periodicals, publications. But this, at least technically, is still just gold owned by the United States. This is not Europeans safe harboring their gold in the United States to keep it away from war. That happened specifically in World War II. That's even in addition to this. Okay, so this is not like earmarked Polish gold, which does flow into the United States, or earmarked British gold. Actually, all that, it is British gold, but that's British gold that was sold to the United States for arms. Okay, and some German gold here. So gold flows in to the United States in both wars, and because of geopolitics, that's why the United States ended up getting a lot of gold. And that's why, once the Bretton Woods Conference starts here at the end of World War II, the United States got a lot of debt, but also a lot of gold. And obviously, this percentage falls rapidly here because the debt is increasing as the United States enters the war. Okay, so the United States has a ton of gold from Britain right here. So this is like basically all the British gold goes in the United States. Britain still doesn't have it back to this day, most of it. And Gordon Brown sold the rest of it in 2008. So Britain lost most all of its gold right here in World War II. Britain was completely bankrupt by this point. So this is Britain, primarily. And then what the United States decides to do is, with scale, borrow from future generations, print dollars to build more stuff. And that creates a superpower right there. This is the chart that shows you how the superpower was born. So notice here, once things are finally settled down, yes, the Cold War starts, but there's at least relative peace in the world. Of course, there's Vietnam is already starting, and we have the Korean War. But relative to the world wars, the truly world-changing landscapes that happened during World War II and World War One, the United States settles in with about 11% backing of its debt. Now, backing is it's a loose term here. If I showed this as a percentage of the monetary base, it would be higher, because the monetary base, again, that's going back to this chart. This is basically the monetary base here. So monetary base is way down here. Let's just find the number. $23 billion. $23 billion is the monetary base. That's how much money the central bank has printed. Okay, so that's 10% of the debt, as you see. 10% of the debt. Let's see how much gold they have in dollar terms. Okay, so it's about 100%. So they're actually at 100% backing here after World War II. See that? Because 10% of the debt, again, is 26 billion based on what I show you here. I'm not showing the gold holdings. I'm showing you a way to find it. The gold holdings are even lower than that, 22 billion, 23 billion. So what that's saying is, I've shown this chart before as a percentage of monetary base. They're actually over 100% capitalized. That is gold to debt. Okay. So, so this is, I think, interesting in the fact that we can see what it took to create a global hegemon. It's not just gold. It's not just weapons. It's not just debt. There's a lot of factors that happen, but it is certainly a geopolitical situation as well, where European gold landed into the United States. Again, that's in addition to this amount. This is just American-owned gold as a proportion of their debt. And then you come to a situation where you only need about 10% of the debt, okay, is gold. And then we can move on till today. It's basically been downhill. Okay, I know I got the zoom. I got to move the zoom button here. But we go from 10% post-Bretton Woods, that is gold, government gold holdings, to total debt. A huge spike here once we leave the gold standard. Okay, huge spike, huge fears, stagflation decade. But then we get on the petrodollar. We have agreements with the Saudis for better energy in exchange for security. Of course, the United States is always going to try to pull the security card. And then we go back. We go back to this same trend, basically. See, we're going down 4%, 6%. We have an interrupted decade here where the dollar is, gold is free floating against the dollar, but it doesn't take long to get back to the same trend, which is pretty wild. So now we're back down here again to 3%, 2, 3, 4%. And down again. Global financial crisis, a little bit rise in the price of gold, gets up to 3%, but look at that, 2%. Today, the United States federal debt of 36.2 trillion. If you want to know sort of if everybody, this is not going to happen because it doesn't happen in economics this way, but if everyone literally wanted to exchange their Treasury bonds, notes, and bills for gold, they couldn't do that even legally. But if they wanted to, there's only 2% backing. I'm not at all saying that that's even a problem, by the way. It's just what it is. It's the nature of the market at the moment. And by the way, the United States is never going to hard default. Okay, so if they need to issue more debt for something else in the future, which they do every year, as we know, and they're going to continue to do no matter what happens with the Doge project, they're just going to issue more dollars, buy more debt, borrow more debt, issue more debt, issue more dollars in case the deficit can't, foreigners can't buy it, or the deficit is not funded with those American dollars that want to buy the debt. Then they'll print the rest. They'll print the balance. But this is the ratio. Okay, so then the question can finally become, let's look at Bitcoin. If we assume that this trend from Bretton Woods, all right, which is you can see the trend clearly. It's 10% to 2%. If we assume that this trend will turn around, and I think that it will, let me zoom in here. You can see it started to bottom out even before the global financial crisis. Of course, again, this was a local bottom in the price of gold. Okay. But then Peter Schiff thought we were going to infinity and beyond. We didn't. We didn't here. Gold price fell. So the gold holdings fell. Now it's going back up again. I should have rounded this to the nearest tenth of a percent, but you can see there about 2%. What's Bitcoin going to do? Once they hold Bitcoin, how's that going to look? I'm going to put that here now. Look at how small this is. This is how much Bitcoin the government holds from all of the seizures of Silk Road, various other seizures, by the way, which is usually what they're doing. There have not been any really direct asset purchases of Bitcoin yet. This comes from our buddies at Bitcoin Treasuries, by the way, which is CoinKite, Rodolfo. He does good work there. Let's now take gold off. Taking off the gold percentage of debt. Let's see how Bitcoin looks. So the trend is great. You can see the Bitcoin price here. But look how small that is. It's not even 0.1%. 0.05% of the government debt. That's how much Bitcoin the government holds at the moment. No question in my mind, this is going to rocket. It's going to rocket up in the next couple of years. No question. Gold is going to go up. Even if they, by the way, the gold holdings aren't changing here. Okay, it's, I always like to say the ounces rather than tons. So let me just find you the exact ounces here. Remember, there's about 6 billion ounces of available gold outstanding. Okay, so if we want to find them in ounces, the United States, it's 261 million ounces of gold. Multiply that by the gold price, you'll get this, you'll be able to make this percentage. And there's a big question mark here, by the way, if this gold is even in the coffers, if it's in Fort Knox, if it's all under the Federal Reserve Bank in New York. There's a big question there. So these are all headwinds against the dollar, and we're just going to have to see. But no question, Bitcoin is going to supplement, if not surpass, the gold holdings. So in dollar terms, right? In dollar terms, this is 800 billion, something like that. $800 billion is gold. And like I said, it might not even be there. $800 billion of gold behind 36.2 trillion in debt. It's only 2%. That's probably going to rise in the future, even if they do nothing and just hold that gold in the vault, if it's there. But the Bitcoin that they have, 100% they're not going to sell. Happy Easter, Geo. Happy Good Friday. Should have said that. Or not that Good Friday. Happy Holy Thursday, I guess it is. Before Good Friday. You tell me, is it official that he levied he's asking, did Trump really just levy a 245% tariff on China? I don't want to spread fake news, so is it official that one is definitely there? I mean, I know the threats are all there, but the latest I saw is he's now negotiating with a block of, 70 countries to isolate China. Again, I'm going to say good luck with that. Tomlin says 100. Does that mean 100% true or 100% tariff? We're going to look at the markets again, but just a little, it's just a little taste, I think, of what's to come. There's no easy way out of this situation. Everybody knows it. We're on a slower rate of growth of the debt than we were in Biden years. It's true. But there's no easy way out of the entitlement situation, the sacred cows, all the promises that the government has made. And we know they're not going to default. They're never going to default. They're going to soft default, just print more if they need to. All right. So, like I said, this will, oops, that's not the right timeline, turn around. It's going down right now. The Fed is tightening is actually not quite the right word, because on the margin they still are lowering interest rates, but they're not printing. They're not printing at the moment, but as we know, Trump will want them to print. I don't think the Democrats will sell either. It's a question from Tom, about the Bitcoin in the government's coffers. No way that they will sell that. By the way, it's a couple 100,000 Bitcoin, right? So that is, I'll pull it up so you can see the nice chart. This is always it's a good refresher for people. Here's the Bitcoin Treasury number, or Bitcoin Treasury website. The number is here, 200,000. 200,000 Bitcoin is current. And so that's where I'm getting my data from. They're doing a good job. That's where, at the moment, this is built up to 200,000. This was a full custody of Silk Road, happened here back in November 2020, which was still a very small proportion of the total debt. This was like 60,000 Bitcoin, 70,000 Bitcoin. And then it's risen to here. But as we know, when that Bitcoin price gets to a few million, plus they're buying more Bitcoin, this is just going to be a huge, huge percentage. And it could actually help the dollar. It could help the dollar. I'm in Latvia, Mr. High Elf, the Baltics. Thank you for joining. Thank you for watching. So I think this is exciting. I think what you see here, if you just think about history repeats, doesn't always rhyme, but it repeats. It's also scary, right? Because living in Eastern Europe, we don't want to be bulldozed by the Russians. Governments do go to safety. Even though they print money, even though they do inflation, they do go to safety historically with hard money. When there is no other way, when there is no other way, for example, just to print money willy-nilly. And so you see this in the United States. The United States got up to 50% of its debt was backed by gold. And again, backing is a loose term there. Okay, there's no money in history that has always been 100% backed forever by gold. Just never has happened. There's assets and there's liabilities. They're different things. Different circumstances require different measures. I'm not saying they're omniscient or make great decisions. This is just how it looks. But the privilege that the United States dollar had from here, all right, which, remember, the debt just juiced up it went up like 5x, right? It was before the U.S. entered World War II. I'm looking at the tooltip here. It's $45 billion in debt, 50% gold, mostly British gold that the British had to pay for arms, and they lost forever. Then the United States went up to 250, pretty in short order, 250. We went up 5x in government debt, and that gold ratio settles down to 10%. It's actually a normal ratio, 10, 20%. It's a normal ratio, so it's kind of normal even to expect this. But we see what happens when you have the supremacy of the dollar and people think that they can sort of print their way out of situations. Lasted a long time, 75 years. 75 years from 10% gold backing now down to 2. So long and short of this is this Bitcoin is going to rocket up as a percentage. It's only 0.05% right now. It's going to skyrocket. You know, we could be here, say, before World War II, or here before World War One, or here before World War II. And by the way, it could take a long time. Thank you, Gio. I don't know if I'm so loved by the the Dave Smith, Scott Horton adjacent folks who sort of U.S. is the enemy of all mankind. But yeah, I try to just give somewhat of a balanced picture, especially coming from Eastern Europe. So that's backing. That's federal debt. That's backing. This is liability side. Who the United States owes that debt to. Right now it's 60% Americans, 23% foreigners, 20% Fed, 17% Fed. I think unless they get more Bitcoin quickly, the Fed will have to take a bigger share of this pie, and that's not good for the dollar. All right. Now let's look at this. Back to the old stocks and bonds move. This has just been really crazy in the last few weeks. Sorry. Here we have the S&P 500. Let's take this off. S&P 500 since the 50s. Okay. Don't need to describe all this. We've described it many times. The issue is usually that remember what I said. Let's put the 10-year on, and let's go here. When there are dips in the markets, like there were here in 2020, like there was here in the GFC, the markets are green, the yield is black, the yield compresses. All right, the same thing as before. Same thing is here. The dollar trade increases. People want government bonds. They want that as a safe haven trade to move away from risky stocks. And that's something that's been in place since the 80s. Okay, before the 80s, it was a bit different. Before the 80s, it was inverse. See, yields go up, markets go down. Yields go up, markets go down. It was only really from the 80s where this sort of trade came. And this was called the Greenspan put, the Bernanke put. Greenspan for sure was the biggest one. That, I mean, you can see the straight line down from 15% 10-year all the way down to here, which I know Greenspan was out by this time. But from Greenspan to Bernanke to Yellen, you're going to save markets by printing a little bit more money, and people just have that interest in the notes or bills or bonds, different durations of U.S. debt, to buy more. All right, so if we go to today, April 17th, and we see what's happened here, remember what I talked about. This is a tough one for Besant, where the markets were down and they stayed down right there and the yields went up. Let's zoom in a little bit more. Okay. So right there, these days were really scary. Now we're maybe back on track. Maybe. Markets are down again. Yields are kind of down. But this was a very scary time. All right, let's look at the Fed funds. not inverted anymore. So theoretically, you don't like. It's usually not a good sign when the long bond is or the long note is below the yield of the overnight, which is the Fed's target. Okay, we're back from being inverted again. We'll see. We were inverted here. But I still think this is going to be the canary in the coal mine. This is when we'll really see it. The 10-year is really what it's all about, and we'll see it. We'll see it rise if the dollar really has some serious weakness and the markets also go down. Another thing which is interesting is the ECB has already cut a lot. This is kind of like the Fed funds for the ECB, the deposit rate. They have cut it down from 4 to 2.5 over the last year. Okay. They should be worried about inflation, and they have said that they are worried about inflation, right? And they've been cutting even more. But they're in this interesting situation now where, oops, did I not take it out? Where the dollar is weakening. So usually they like to work together on this, right? And the euro continues to get stronger against the dollar. Up is bad for the dollar here, right? So it's taking more dollars to buy 1 euro. All while the ECB weakens its currency, as evidenced by lower interest rates. So they're going to do it more. ECB is going to even lower it more, which again, this all portends more bullishness for hard assets. This is like giving the ECB more gasoline to lower rates, in my opinion. And that's where we are. Let me know if you guys want to see another chart. That's really all I had for today. But I think Trump wants a new world. I think he's going to get it. If you look from here, even from here, all right, so this is the Trump-Putin phone call. Actually, it was here, somewhere here. Back it up. I'm not talking politics here. I'm just talking reality of what Trump is trying to do and the Trump admin. He decided somewhere around here to go mano a mano with Putin. He hadn't fully unleashed on Xi yet. And then eventually, Liberation Day comes all the way over here. But still, it's, there's a barrage of news. And the markets go from 6,000 down to 5. And I think generally, if you look from here, generally you can say here he's okay, right? So markets are going down. Yields are also going down. Oh, whoops, sorry. That's not fully zoomed in. There we go. Look at my time scales. There we go. From here, he's okay. But from here, from the phone call, which I can't remember the exact date, somewhere here in mid-February with Putin, markets are way down from over 6 to 5, now to 5.2. But the yield is flat. 4.3. 4.4. It's a little bit lower. So he's all right. Technically, it's doing, if you look over the midterm, the markets are doing what you would expect. But there's a lot more to come. I mean, I'm not on TikTok, but I'm hearing these hilarious memes that even the Chinese are putting out against JD Vance and Trump and co. I'm not reveling in them by any means either. If the markets still stay low or go down, or this black line drifts higher, that's a big problem. Just remember that. Hasn't happened yet. Like from this point, it's interesting. March 3rd, the 10-year was 4.2. S&P 5.8. Now the S&P 5.2 and the 10-year is 4.3. So maybe you can say that this point is an interesting day. Again, what happened there with Trump, I don't know, but sorry. Could this be the great unwinding? That's the question. We already see from this period, from COVID, that the long bond has not been able to instill the confidence in investors to go back down to pre-COVID levels. Now the question is just going to be where the flow of investor funds goes. Let me know if you guys have any questions. Check in on Bitcoin. Again, I'm not a technical trader, so I'm not going to draw any lines. I'm not going to tell you where it's going to go. It's not this channel, but it is also very interesting to note that as a risk, I shouldn't say that, it's a non-correlated asset so far, and that non-correlation has actually kind of held. Okay, so markets have fallen a lot. Yes, Bitcoin fell 15%. But compared to the markets, at least what markets are supposed to do, especially in relation to the Treasury, the 10-year yield, markets, I would say, have fallen much more and underperformed compared to the Treasury. And Bitcoin, it's kind of holding its own. Yeah, people thought it was going to dip down here. I'm hearing from my technical trader friends the next target is in the 50s. But, what do I know? I can't say anything. I don't have much. You can clearly see, obviously, a range here in the 50s before it broke out in the Trump election. When in doubt, Bitcoin and chill, as Dorsey says. These are long trends, long-term movements. I was growing up here in the 80s and the 90s, blissfully unaware to any of this. And then you start investing here after the .com. Then you have this. Makes you try to figure out other things about the markets. Long-term trends, long-term changes. I would like to get these charts, this exact same type of chart for, all the European Euro bonds together, all the Japanese bonds and its debt, and then, of course, the Chinese. Sterling as well, separately, deserves its own category. It's kind of that idea that, we talked about this yesterday with Stuart. Like Rubio is saying they're still committed to Europe. They're glad the Europeans are still spending money on their security, but they want the Europeans to buy American now. And I wonder if the administration anticipated this kind of a blowback against the dollar on every level, whether it's coming from the Chinese or whether it's the cold shoulder that now the European Union might be giving to the U.S. or not necessarily cold shoulder, but my understanding those negotiations are not going well. And they got 70 other trade deals to negotiate in 70 days now or something. 80 days, whatever it is. It might be like this be careful what you wish for moment, because this is pure seigniorage, really, from this point on for the United States. From Bretton Woods to now, even with losing the gold standard here, foreigners bought more dollars and the Federal Reserve owned more dollars, generally all throughout this period. If that has to turn around, you can't have your cake and eat it too. Like, if that has to turn around, then by nature, I think yields will rise. Price of bonds will fall. And the dollar will suffer. Not something that I'm saying flippantly. Again, how many newsletters told me this was going to happen here? Well, bonds, people bought more and more. Foreigners are buying bonds. I've read so many newsletters over the years that were just doom and gloomers and all this. Maybe it can stay in this 50 to 60% range of Americans holding debt for another 10 years. I can't say I know anything for sure, except for the power curve of Bitcoin. It's a great power curve. It's a great trend line. But it does seem like the age of American supremacy is certainly waning. And unless Trump pulls this art of the deal, I don't see this black line, which is now 23%, which is foreigner ownership of debt. I don't necessarily see that going back up to 35%, unless anybody else sees that. So the Fed is going to have to print. Let's take this off. Here's the Fed's portion. It's a tricky situation. So this is from perhaps the end. This, like, if we look back in history, this could be, COVID could have been the end of the bond bull for the United States. It could have. I'm not saying it is. It could have. Where the 10-year now starts in an uptrend, weaker interest in government bonds, more inflation, higher yields to counter that inflation. And more spreading in these figures. When the stock market goes down, the bond yields go up rather than down immediately. It's just a function of scale. This has nothing to do with anything, but it would be interesting if, you see the 10-year. This is not like scientific, but it's interesting that on this scale, you see, The 10-year broke above here, went back under the S&P last year. And now if it, again, breaks back, I mean, if yields rise and the S&P is still down or flat, and I wonder just, you know, if that sort of trend just continues. It's not a scientific observation, obviously, because this is, now they're not aligned. It's just a question of scale. It's a question of how big your window is when you frame it. Like here, it's already broken above. Whatever. Just saying. All right, guys. I got a busy day today, so I'm not going to do too much more. Anybody have any other questions? We'll keep tracking this one. This is a good one. It's minuscule right now, but the government holdings compared to its debt, the government holdings of Bitcoin compared to its debt is going to explode. I can assure you of that. Maybe that's enough to save the dollar, actually. Maybe. That's kind of the Michael Saylor view, isn't it? And this will go up too. Remember, they're not even buying or selling gold. This is just the price of gold changing this percentage. Okay? And there always is the question mark whether this gold is actually there. So there is that. All right. Gonna leave it there. Thank you for watching. Happy Holy Thursday for those practicing. And I'll speak to you tomorrow.